Hey everyone, and welcome back to the channel where we demystify the wild world of hard-to-borrow stocks and short squeezes. Today, we're diving deep into a fascinating ticker that's popped up on our screen at ATPC Corporation, or ATPC. This isn't a generic overview, we're going to dissect ATPC's specific situation, examining why it's become one of the most expensive stocks to short right now. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight to it. ATPC Corporation, trading under the ticker ATPC, is an investment holding company that operates primarily in Malaysia. They supply health and wellness products and offer health solution advisory services, placing them firmly in the consumer defensive/packaged food sector. This is a micro-cap stock with a current market capitalization of just $2.03 million. Looking at the recent price action, ATPC has seen some significant fluctuations. Today, the stock is down 1.70%. Over the last 5 days, it shed 4.55%, and in the past 30 days, has seen a steep decline of 40.46%. So chart, ATPC 30-day price in terms of volume. Today's volume is a very low 29,561 shares, which is dramatically below its 30-day average volume of 3,970,192 shares. That means its relative volume is sitting at Xerox average right now. Stark contrast. What is cost to borrow and why it matters? So, why are we talking about ATPC today? It all comes down to something called the cost to borrow, or CTB. For those new to this, when you want to short a stock, you first have to borrow shares from someone who owns them. The cost to borrow is the annualized fee the short sellers pay to borrow those shares. Think of it like renting a car. The more in demand a specific car is, or the fewer available cars there are, the higher the daily rental rate. In the stock market, if a stock is highly sought after by short sellers, or if there are very few shares available to borrow, that CTB fee can skyrocket. And yes, it can absolutely exceed 100% annually, sometimes much more, because it's an interest rate based on supply and demand for shares, not a traditional loan. Why this stock is hard to borrow right now. This brings us back to ATPC Corporation. Our screener flagged ATPC with an eye-watering cost to borrow fee of 674.3% annualized. Highlight 674.3%. That is an incredibly high fee, making it extremely expensive for anyone to maintain a short position in ATPC for an extended period. Why such a high fee? Well, part of the puzzle is ATPC's estimated float, which is only 0.5 million shares. A small float means there are very few shares generally available for trading and, critically, even fewer available to borrow. When short sellers are eager to bet against a company and there's a tiny pool of shares to borrow from, the price of borrowing those shares, the CTB, naturally goes through the roof. While we don't have CTB momentum or specific shares available to borrow, data for ATPC right now at 674.3% CTB fee alone is a screaming indicator of how hard it is to get your hands on shares to short. Our internal composite squeeze score for ATPC currently sits at 49.1, indicating a moderate but not extreme potential for a squeeze. Squeeze mechanics explained. So, what does a high cost to borrow have to do with the short squeeze? It's all about pressure. When a stock is hard to borrow and the CTB fee is astronomical, every day a short seller holds their position, it costs them a significant amount of money. If the stock price then starts to rise even a little, these short sellers are caught in a double bind, losing money on their position and paying exorbitant fees. Show animation, price rising, CTB increasing. This pressure can force them to cover their shorts, which means buying back the shares they initially borrowed and sold. If many short sellers are forced to cover at the same time, this rush to buy creates a surge in demand, driving the stock price even higher. This upward momentum then triggers more short sellers to cover, leading to a cascading effect known as a short squeeze. Dilution risk check. Before we get too excited, let's talk about a critical risk factor, dilution. Our checks show no recent dilutive SEC filings like -1s, -3s, or 424 BS for ATPC within the last 90 days. That's a good sign. But what is dilution, and why does it matter? Dilution occurs when a company issues new shares into the market, often to raise capital. While it can be beneficial for a company in the long run, it can completely undermine a short squeeze thesis. If new shares flood the market, it increases the overall supply of shares. This can provide short sellers with an easy way to buy back shares without driving the price up, effectively removing the pressure that causes a squeeze. Even with the sky-high CTB, dilution can neutralize or negate any squeeze potential. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Now, it's crucial to remember that a high cost to borrow does not guarantee a short squeeze. It can also mean that short sellers have very strong conviction in the company's fundamental weakness and are willing to pay those high fees to bet against it. For ATPC, with its small market cap and recent price decline, that's a real possibility. To assess future squeeze potential, we would want to watch for a few things: continued high CTB, or even a decrease in the availability of shares to borrow. But most importantly, we'd look for significant upward price momentum on abnormally high volume. For ATPC, today's volume is incredibly low compared to its average, suggesting a lack of strong buying interest right now despite the extreme CTB. Agape ATP Corporation, ATPC, presents a very interesting case study with its astonishing 674.3% annualized cost to borrow and tiny 0.5 million share float. These are certainly ingredients that can contribute to a short squeeze scenario, but as we've seen, it doesn't guarantee one, especially given its recent price action and current low trading volume. Understanding these dynamics is key to navigating the markets responsibly. Always do your homework, understand the risks, and never invest more than you can afford to lose. If you found this deep dive into ATPC insightful, please hit the like button, subscribe for more unique stock analysis, and let us know in the comments what other hard to borrow stocks you'd like us to cover.